In this session, we will look into the basics of options. Some people learn by reading, some people learn by doing. I am of the second category, and I am pretty sure there will also be people who learn by doing. So, this tutorial on the basics of options, a practical introduction to options, is for mainly for people who like to see things, have a hands-on experience, and to learn things. So this is for them. All are welcome to the course. So let's first look at Apple. Apple. So in the right side you have a what you see is the price action of Apple. So Apple prices is a 15 minutes chart of Apple. Uh, so you see the Apple prices goes up. So this is April 10th. If you look, let's start from a daily chart. So this is from February 2022. Now this is 2024. So the price went so up to close to 180 in 2022 August, and it went down to around 130, 127, and then again went up. It crossed 180 in around 20, June 2023, and went up, and then again went back to 165 and went up to around 200, again went back now to 165. So this is the price action on a daily basis. Uh, so let's go back here. So what are options? On the left side, what you see is the option chain. What does that mean? So this is also Apple. You see here Apple. Here on the right side also Apple. Uh, an option is, you can imagine, you can understand option as something like an insurance. There are also similarities and differences between an option and an insurance. You can think about it and write in the comments below what are the similarities and differences that you think between an option and insurance. But there are a lot of similarities with insurance. It's easy to understand. So if you think about insurance, a life insurance, if you buy a insurance for your if you have a life insurance contract with an insurance company, um, what happens? So that means that within a period of next 20 years, let's say, and if you die within these 20 years, within these 20 years, it's very important, is that the expiry date is the 20 years. um, Within these 20 years, if you die, you get, let's say, 100,000 to your family. And this is the insurance. So insurance, you are being insured for $100,000 for next 20 years. So this means if you die within this period, your family gets this amount, and for this thing you pay a premium. And here you pay a premium every month. Let's say $10. So you pay $10 to have an insurance for you, for a life insurance for you, so that your family gets 100,000 euros if something happens to you, or if you die during this time. If you die after 20 years, your insurance is no more valid. So you need to either extend your insurance or you need to have another insurance. So your expiry date is expiry date is 20 years. You can also look at option in something in this way. So imagine, so we saw the Apple price action. So Apple prices went up and went down. There are people, there are institutions, big players who buy thousands of stocks of Apple. Yeah, but they, and so it was just one Apple stock costs like now 167.50. If they buy 10,000 stocks of Apple, it's a huge amount. And all of a sudden, if something happens, the Apple, some big issue came, price went down, start going down and down and down, it will be a huge loss for the company who bought these Apple stocks. So the Apple stock buyers, big players, what they do is they buy an insurance for their position in Apple, and that is what you can call as a option. So in this case, what they will do is if they have a huge position in Apple, what they will do is they will buy an insurance for Apple for a specific price. So for example, here you see the price has been around 165 for a long time, and there is also a chance, okay, maybe price will go up to if you go back again, let's say on a weekly basis, this is a weekly chart here, you see the price around this thing. So I bet that, or let's say the big players bet the price will not go beyond 125 in, let's say in 1 month. So within 1 month, price will not go beyond 125. But if in case price goes beyond 125, we need that they will be buying an insurance, and this is called the options. And like a normal insurance, they also need to pay premium for that. And let's see how much this will cost to buy a protection for the price for Apple. So now this is April 19th. So this is what you see here in the top. So what you see in the left side, this is the option chain or the different option prices. Yeah, and in the middle is the strike price. So these are the different uh, price points of the Apple. So here we are talking about 165. So that is why we have the line here. This is the around price is between 165 and 170. That is why the line is between this line. So this is the strike price. Strike price is the price of the underlying Apple. So Apple is the underlying asset behind this option. So this Apple stock. So there is a strike price for this Apples. And now in the top, what you see is the expiry date of that option. So since we are interested in to say uh, 1 month, so within 1 month, we say the price will not go beyond 125. Yeah, so 1 month it's around, I took May 17 now, today is 19th of April. So the 1 month is like, let's say, maybe let's take one more one afterwards. So 24th of May, this is in 35 days. Okay, so our prediction is price will not go beyond below 125. So if you look at 125 strike price, 1 minute. So here here we see 125 strike price. 125 strike price in the put side, in the right side, you see that there is a bid ask value for this. So this is the bid column and this is the ask column. So that means 125, you can buy this option for 15 cents. So one option contract is representing 100 stocks. So if you buy this option for 15 cents, that means you need to pay $15. Um, uh, that means you get a protection for 100 of your shares. So that means, what does that mean? So you are getting an insurance. Think of this as an insurance. You get an insurance that the price will not go beyond 125. If it goes, what happens? What do they do? So what this means, if the price goes below 125, you as an option buyer has the to right to sell your stocks at the price of 125. So this is the minimum you are able to, or the maximum loss you are ready to take. So you will be able to, let's say price went to 100, but you will be able to sell Apple stocks for 125. So and the premium that you have to pay is $15. $15. This is the value for money. You just pay $15 for 1 month. You get a protection for your 100 Apple stocks. This is how an option work. So we're just talking about the put side. So I will come to this put and call later. So that means this is why people buy options. So the big players buy options. So so that they can protect their positions. Now, what happens when the price start going down and down? So let's open this one. If you click on this, you see. Um, just want to check this one. Okay, so if you click on here, you will see. Just seeing if you're able to see it here. No, okay, it's fine. I wanted to also show you the option price dynamics. Um, is it a problem for all, or is it because the market is okay? You can see it here. Um, this is another strike, but I will give it. Can give you if you take hourly, maybe it's much more clear. Okay, so let's take 125 here. I don't see because the price, it can be that the because market is not at open, that's why we don't see it. It's fine. Okay, so basically what happens is when the um, um, when the price changes, the value of the option also changes. This is what I tried to show you with this graph, but now the market is not at open. That may be the reason they are not showing this graph in the graph. So you will see a similar graph, also for this option price. This price, what you see as of now for the option is 15. Now imagine the price start going down and down of the for the Apple. This option price, so now it's 65. Let's say the price goes start going down and down to 120 towards 125. The option price will also go up. So that means you need to pay more to for the premium to buy an option protection or the option for Apple. So this is at a very very high level why people buy options. So what I just explained is only the one the put side. That means the price going down. Now there are also situations where when the people want protection from price going up. An example would be, let's say, oil. Yeah. So there are companies who needs big amount of oil for their for running their engines and so on, but the oil prices is highly fluctuating, it's highly volatile. A war in Iran and Russia, these type of things can increase the price so high, and this will have a unexpected impact on the business. So the price of the oil will go up, and this is something very difficult to predict and difficult to charge the clients for a company. So what they do is they buy a protection in the upside. So when the price goes up, so that is what in what you see in the left side of this option chain. So for example, uh, uh, let's say for 165 strike price, 165 strike price. So 165 strike price, you have two values here. So on the right side, we have bid and ask prices. This is the put side of the option. On the left side, you also have bid and ask. Here, bid value, ask price. This is the call options. So that means call options are protection for the price to go up. When the price goes up, you get you can buy a protection. And on the right side is a put options. Put options are like a protection for price to go down from a buyer's perspective for those who buy options. Now in the insurance world, there are insurance companies that gives protection. They issue the insurance. In the option world, there are option sellers who sell this option. So there is, in this case, of 125 price, what we discussed before, there are option sellers who are offering to buy it from you, when buy it from the buyers, the 100 100 Apple stocks for 125 price, when the price goes down to, let's say, 100. So someone has to sell these options. So there are no insurance companies, but there are option sellers. So it can be big players, it can also be retail sellers like normal people. So as a retail seller, what they do is they from a seller's, what we just discussed is from a buyer's perspective. From a seller's perspective, they say, the price will never go. Yeah. So if option for a option seller's perspective, they will think, okay, price will never go below 125. So they can sell this option for 15 cents per contract. That means if the price never reached 125 or low, he can keep the premium, just like insurance company. So you pay insurance premium to the insurance companies. Here, for insurance companies, they charge it monthly. um, and if nothing happens to you, you are still alive after 20 years, they can keep the premium. So they can keep the money. Just like that, option sellers also can keep the premium. So this is why people sell options, and there is also reasons why people buy options. uh, the reasoning I explained until now is for protection against price going up and protection against price going down. Now, there are also traders. So traders who buy and sell options to capitalize on the change in the option price. Let me see if I can show you again this thing. Let me go back here, because I tried one time, it did not work. Maybe we are lucky here. Okay, so I think we can see it here. So I think what we took is the option 160. So this option of 160 in April 15th, let's say daily. Will it work for daily? Uh, Hourly. Okay, here. Look at this. So this is the option, put option for 160 strike price. Yeah, so 160 strike price. So that means someone is giving you a protection. If the price goes below 160, they will buy this option, buy 100 stocks of Apple for 160 euros, $160. So the price of this option has went down and went up. In order to show this from a chart perspective, I will also want to show you something here. Let me also open a chart here. um, okay, here maybe this will work. um, let's move this up a little bit. What I want to show you is to compare this option pricing with the real stock pricing, so that you see the difference. What happens, the price goes up, how the option price changes here. So here I will need to change it here to group 1. So if you do not know what I am doing here, check out my another video how to set up this TWS platform for option trading. Then you will be able to see this. Okay, so here we have Apple. So here Apple on a hourly chart. Hourly chart, the price on the here, this hourly chart, the price you see is going down. Let's say from April 8th to April 18th, price has gone down. price is going down means in the strike price is going down and down. This line will go is going down and down. So over the over from starting from April 16 to until April 18, price is going down. Now if you look at the option the put option for this specific strike of 160, you see 160 here, the option price has gone up. So April 16th option price was around 180 180, yeah, option was 180. Now the on April, that was on April 16th. Now on April 18th the price is close to 260. So there's a difference there. So it's just $2, it's 260, $2.60 per contract. So you have to pay 260. 2 days ago it was one, how much was it, 180. So you see that in 2 days you have a gain if you have bought this option. Yeah, there's an overlapping, there's a red is coming because there is an overlap between these things. Okay, this will work now. Yes, okay. So what you see here is when the price goes up, the put option prices will go up. When the price go down, put option prices will go up. That is what you see here. And the second reason why people buy options is to capitalize on this change in price. So you can buy this option and sell this option. So for example, you can buy the put option, and you can sell this put option if you think that the price will go up. So that means you can capitalize on this gain on the price change. So from a put option perspective, now now you may be thinking for option buyer. So for option buyer, this will create a loss if the price goes down. Option sellers who have sold the put option, but there are option sellers selling the call options. Let's say the option sellers who uh, uh, option sellers who has sold a call option. So they on April 18, let's say April 18th, um, so April 16th, they sold an option. So this is, let's look from a option seller's perspective. They sold an option for 225. So they got a premium for 225, and they give this protection if the price goes up. And you see the premium has gone down and down and down. So price went down instead. Yeah, price did not go up, price went down. So that means they can, if the by within this 1 month time, if the price never went above, in this case 185, they can keep this premium. Or if they decide, okay, now now it's 2 days, now I have some gain, I got this premium of 225. Now I have sold this option, now I will buy back this option. So he sold this option for $2 200 around $200. Now the price of buying this is just 80 now. So he got 200. Now he has to pay only 80 to get back this option. So that means he still he make a gain here by just keeping to this option for some couple of days. So this is how people make money, this is the reason why people buy or sell options. Okay, so is this all clear? Is there anything not clear about options, call option, put option, why people buy and sell option? If there is any question, please write down in the comments below. Now we looked at the options, why people buy and sell options. Now let's do some real option selling. and option buying, just to get an idea of how option buying and selling look like. So as I told before, if you do not know how to set up this screen like this, look at my another video how to set up the TWS trading workstation for option selling, and you will be able to see the details how I set up this screen like this. Now let's look into this option chain. So in this option chain, there's an option chain for different expiry dates. So if you look at here, expiry date on 1926, there are weekly options. So the options expiring on weekly, there are options expiring on monthly, and there are some options which are mainly for indexes, SPY and others. They are options expiring on a daily basis. So here we are talking about Apple. So the Apple is mainly, as of today, it's mainly weekly expiry options. And what you see here are the expiry date of different options. So uh, just to give you an idea, so we talked about 125 strike price. Yeah, 125 strike price of put option, it costs 10 $10. Now if you look on 24th expiry, on 20 on the same strike price 125, it's 15 $15. Now if there is after 42 days, for the same strike price 125, it is $23. So you see the option premium goes higher and higher when you are far away from the current date. So that means there is more risk involved. Price can change so much. So that means you are paying a higher premium for farther away from the when it is further away from the current date. So this is what we see in the top part. On here, you see different columns. I will come to this delta in a minute, but there is bid size, is the number of people who are bidding for these values. There is bid, ask price, this ask size also. There is strike price. This is what I said, that this is a value in the underlying asset. Here in this case, Apple. Apple's value 210, 205, 200, and so on. Some of you might ask, so where is the strike price for 170.5? There is no strike price for 170.5. There is only between 170 and 175. And all these prices, option prices and the real the asset prices, they are very much correlated. And sometimes you see, if you look at some of the price at certain levels, these fixed levels, you see a sudden change sometimes. Say for example at 160, you see a sudden quick change in the real price. It's because of the activity at the option level. There is big change happening because the option strike price is at these levels 160, 155, and so on. So this is why you also see sometimes, not always, sometimes, as quick, very fast actions at specific price levels. Okay, so now we also see on the ask size, bid size, delta values in the left side as well as in the right side. And as I told before, so in the right side, this is the put side, meaning protection for against going down, and in the left side, it's the call side, which is the protection against going up, the price going up. Okay, so now what we are going to do is, okay, before we go, I want to slightly touch this value delta. Um, when you talk about options, there are option Greeks. So if you're curious about option Greeks, you want to know more about option Greeks, check in Google for option Greeks. What are option Greeks? There are different Greek values, delta, gamma, and so on, and you can look at it what each one of this means. For now, as a basic codes on options, you can imagine delta as a probability. So you don't see the value delta here because the market is not yet open. When the market opens, you will be able to see the delta values here. And delta basically means what is the probability that the price will reach at this level. So there will be delta for each of these price levels. So what is the probability of price reaching 140? That is the delta value. So it's a mathematically calculated value based on, there's a model behind that and so on. So it gives a mathematical probability of the price reaching this level at this within this expiry date. That is the delta value. The details you can look at, I will cover it in a different video, but if you're curious, just go into Google and search for Greeks of options, then you will be able to see. Okay, so now what we are going to do is really buy an option as well as a sell an option. So let's say we are going to uh, sell an option. So we think that the price will not go beyond 125. Uh, so what we are going to do is we are going to sell an option. We sell, you see here, we sell an option for 31st of May and the strike price of not 230 but 125. Oh, sorry, this is gold. So here we need to take here. So here we have 125 strike price. Um, you, you can, here you need to sell an option. So we are selling an option with a strike price of 125. So if you, and you see that the price range, this ask bid price, there is a huge range between 5 cents and 23 cents. You sell, let's say you can take a value between this 5 and 23. Maybe you say 10. You can sell this for sell. Maybe there will be people who will be ready to buy for one option contract for 10 cents. And if you press submit, let's see, this is a paper trading account. This is why um, uh, you see this on messages. So you see that I sold an option for 10 $10. So that means if someone buys an option from me, so someone has to buy. So there is always a seller and a buyer. If this someone buys this option, so I am giving him a protection for the price of Apple, that it doesn't go, it goes, and it goes below 125, I will buy it from him for 125 per Apple stock. So that is the protection I'm giving him. You see that I sold an option here. This is how you sell an option. Now you can also buy an
Order
option.
cancelled.
So I cancel this order. Now you can also buy an option. So let's say I buy this option for 125 and put option. Again, the price is between 5 and 23. Let's say I want to buy it for 10. Okay, so I'm going to buy this option for 10. I am placing the order here. Maybe there will be a seller who is ready to sell this option for $10. So I transmit this order. Okay, so so here I bought an option. Okay, so
Order cancelled.
now I cancel the order. In another videos, I will you can see how option sellers manage their risk, because they also need to manage their risk, right? So when when the price goes below 125, they have the price, so they have a risk there. So in order to do that, option sellers have different strategies, different option selling strategy. One of them is called credit spread. I will cover this in a different video. Check some of my videos there. And what they do is they will sell an option. So let's say if I want 25, and what they will do is I will buy an option just below that. So 125 they will sell, and then they will buy an option for 120, and then as they sell this as a combined package, and then this submit the order. You see, now we are selling uh, it's called credit spread. You sell an option and you buy an option. So you basically, the option seller will get 8 cents by selling an option, and at the same time buying an option right next to it, so that they get they will cap the maximum loss that they will have from this option selling. So this is
Order
how
cancelled.
option sellers manage their risk. So, in summary, so what we learned today is about options. We learned about the price action and how this is connected to the option prices. Yeah, and we also saw in the left side option chain, and we also saw the different strike prices, different asks and bid prices. We also saw how to sell option, how to buy an option, why people buy options, why people sell options, how they can make money by selling and buying options. If you have any questions, anything not clear, please write down your questions in the comment section below. I will create a video just for you, and you will be notified. If you subscribe to this channel, you will be notified whenever I upload a new video. Thanks a lot for watching, and see you in the next